How's it going, everybody? In this video, we're going to be talking about the unique trade setups using market profile versus volume profile. So in this video, I'm not going to be covering all the different techniques like the different distribution days, the volume profile types, that sort of thing. If you want to learn more about that, click the video up here in the top right. It's going to pop up. That is on the volume profile series. If you watch that series, it will go over all the specifics of the volume profile and those types of things you can use with market profile as well. In this video, we're specifically talking about the unique setups that you can only use market profile for. Okay, so let's get started. Starting off, I'm going to be using a few terms that I want to clarify right now. The main term I'm going to be using is a TPO. A TPO is what's known as a time price opportunity. Basically, every single letter that you see on the market profile is known as a TPO. Okay, so if you ever hear me say TPO, I'm just referring to each of these individual letters. All right, so getting started, my TPO settings are 2 points each, which is 8 ticks. So whatever you guys use for your broker or your trading platform, if it allows you to change the TPO settings, I typically use 2 points, which is 8 ticks on ES. Most of the time, you can just leave that setting on auto, and it will give you a pretty standard setting by itself. Now, typically, you want to be using market profile on a 30-minute time frame. Okay, that is the main time frame that basically all volume profile and market profile traders are using. Okay, and based on the opening colors, I like to use the first 3 sessions. I will color them individually. So as you can see here, I have the first session colored red, the second session colored green, and then the third session colored blue. And then finally, I like to color the closing session as well. And then I leave the rest of the sessions throughout the day the same color. Now that is basically just personal preference, but that's what I'd like to do for my profile. Okay, now that we got the settings done with, let's talk about the actual trade setups. So the first trade setup we're going to talk about is the poor high. Now, if we go over, there's actually an example of this happening on the 27th, and we had a poor high form on the closing session here. So what a poor high is basically when you do not have a tail, you do not have an excess. What is excess? Excess is really when you have a value being found, right? But then you start to push away from that value and you start to form these single print tails on the bottom or the high of that value. Basically the high of the day or the low of the day. Typically you want to see those tails, which creates that excess. That is a proper level, a proper tail. If you do not have a single print tail, that is not a proper level. That is what's known as a poor level. It's either going to be a poor high, which is on the high, or a poor low, which is on the low. Now, how you find a poor high or poor low is when there is not a single print, but there is matching TPOs on that level. So in this case, we have a matching TPO on L and M. Now it doesn't have to be 2 TPOs. This could be 5 TPOs, 6 TPOs, it doesn't matter. As long as it's more than 1 TPO and they are lining up perfectly with no excess above or below if it would be a poor low. So in this case, we're seeing a poor high. So if this was a proper tail, we should see single prints on either the L or the M session on that high. Now, typically, the textbook will tell you they want to see 2 TPOs, not just 1 single TPO. So let's take this day here. This would be the pre-market session. You can see that we have that lowercase e on the top of that day. That is technically still a poor high because you do not have 2 TPO single prints on that high or on the low. So it's actually giving you a poor low as well. So basically, you want to see at least 2 single print TPOs without any matching price action. Okay. And if there is matching price action, you just have to have that excess above or below it. Okay. So you need those single prints. So for example, this could have like 5 TPOs lined up on the top, but as long as there's at least a couple of single prints above that, then that is not a poor high. Okay, so how do you trade the poor high? Basically, when you see that poor high form, let's say we have the L session here creates the top, we have the M session come up and it double tops on that same price, and then it starts to kind of consolidate or pull back. Now, typically what's going to happen with a poor high or a poor low, it's going to pull away from that level and then it's going to consolidate. So in this case, we actually did just that, but because it was the close of the day, we weren't able to use that as a trade setup. But let's screenshot this really quick so we can show you kind of how we would have traded this. So if we grab this here, we can see that this is the poor high, and we can see that that M session was pushing lower. How do I know that that M session is pushing lower? Because we have this little arrow here that tells us where the close of the day is, and I know that that M session is the last session of the day. So I know that we kind of topped out there, and then we pushed down. So this was actually playing out perfectly with what you would have wanted to see for the poor high trade. We just didn't have enough time to play that trade out. And if it was going to play that trade out, it's known as a repair. So we pull away from the high, it starts to consolidate, and then we want to look for that repair. Basically what repair means is exactly what the regular definition of repair means. It's going to fix that problem. So it's going to fix the poor high, okay? So we are going to consolidate here. We're going to look for the trade somewhere in this area. You basically put your stop loss below wherever that consolidation is, or you look for some major supports on the volume profile or the market profile. Wherever that major support is, you just want to make sure you are putting your stop loss below those levels, and then you are targeting the poor high as your main get out, okay? So in this case, you would have taken the trade somewhere around, let's see where that price is. That price would have been somewhere around 40.23, and then you would have been looking for about a 20-point move to repair that high. Okay, in this case, we didn't get that repair because the market closed. Now, in this scenario, because the market did not give us the chance to play that repair trade, what we can actually look for is we can watch that on the next trade day. So let's go ahead and close this. This was on the 27th, right? And then we have the 27th / the 28th pre-market. So this is the after hours. And then we have the day on the 28th. And that day was extremely bullish. So knowing that there was a poor high here that we did not have the chance to repair, as long as we were showing somewhat of some buy pressure on that open of the next day, we could still be looking for that poor high trade, even though it's not on the same day. Okay. Now, typically, some traders will like to look at poor high and poor low levels, and they'll leave them on their chart forever. They don't care if it's like a week away or a month away. They're still going to watch those levels to see if they can get those repair trades. Typically with me, I only like to see those repairs either the same day or the day after. If it's a very obvious level, if we're clearly putting and building some liquidity outside that poor high or poor low, maybe we can get a sweep and repair that level. Then I'll pay attention to it if it's past the first or second day, but I'm not going to watch that level like a week or a month away. You typically want to see that repair as soon as possible. Okay. So as we can see, the next day there, you did get that poor high repair. So that trade was finished. Now, for the target, you basically would want to take profit as soon as that poor high is repaired, but you can wait and see if the buy pressure maintains. Sometimes you'll see the price will repair the poor high, and that's all it was, and it will come right back down and start selling again. So you want to watch out for those potential sweeps. You want to take profit as soon as that poor high or poor low is broken, but you can leave some runners just in case, like we see something like this, where it continues to run even after repairing that level. Okay, so poor low would be basically the same exact thing. As I said, there's actually a poor low right here that also got repaired on the day after as well. And a poor low is exactly the same thing. It's when you have a matching TPO or you do not have at least two single prints creating that tail. So in this case, we have one single print, but we do not have two single prints. Now, in my case, because I use a 2-point TPO, most people will use something smaller than that. So if you were using, say, a 1-point TPO, we would have actually had two single prints here. But because I use a 2-point TPO, we only have one single print. So in that case, you have to ask yourself, is that actually a poor low or not? It really depends on your settings. Now, in this case, I would determine that as a poor low. Okay. All right, moving on to the next trade setup. The next trade setup is the initial balance and the initial balance extension trade. So if you guys don't know what initial balance is, it's the first 30 minutes or the first 1 hour of the trading session, which is the cash session, basically starting from 9:30 to 10:30. The majority of people that I know that trade market profile or order flow, they will use the first 1 hour. Some people like to use the first 30 minutes if they like to get those trades a lot sooner. So in this case, if we're using the standard market profile, that would be the A session and the B session. So we look at the A session and the B session, we find the highest point and the lowest point, and that will give us the initial balance. Now, there's another trick that you can do with the initial balance. I used to do this a lot on stream. I haven't done it that much lately, but instead of looking at just the high and the low of the initial balance, you can actually pull up a volume profile of that first 1 hour session and find out where the actual value is being traded. That's only if you want to be very exact and you want to look for those micro trades. You can look where the value area of the initial balance is. If you don't care about those extremely micro trades, then just pay attention to wherever the highest price and the lowest price of the first two sessions is located. So in this case, the highest price would be 41.23. The lowest price would be somewhere around 40.81. Okay, so now that we know where the initial balance is, we can kind of determine where our bias is on the day once we begin to break that high or the low of that initial balance. So if we start to find a lot of value outside the top of the initial balance, then that would be a bullish bias day. If we start to break the low of the initial balance and start to find a lot of value below the low, then we would want to be leaning bearish on that initial balance. Okay. Another thing that has not been happening very often lately, but back when the market wasn't so volatile, people would refer to the initial range and they would look for a very wide or a very short initial range. If the initial range was extremely wide, meaning that first session, so the A session here would be the initial range, not the initial balance. They're different, okay? So the initial range would be just that first session. So looking at the A high and the A low, if that was an extremely wide initial range, it's going to be very hard to find a lot of value either above that or below that initial range. Now, because the market since COVID has been so volatile, that trade setup isn't really what it used to be. Pre-COVID, if you had an extremely volatile initial range, which gave you a very wide initial range, you would balance out for the rest of the day. And for you guys that don't know the term balance out, it's basically just a fancy word for ranging. So you would balance out the rest of the day inside that initial range. We are not seeing that very often nowadays, but just keep that in the back of your mind. If you have a very wide initial range, sometimes it is very hard to break that high and low, and you're going to continue to range throughout the day. So maybe if we saw an extremely wide A session, let me see if I can find an example. None of these A sessions are extremely wide, like I was saying. But let's say right here, we have this really wide A session, and then we have the B session. It attempted to go lower, but then it could not continue lower. It actually popped back up and continued to the upside. Same thing with the C session. The C session tried to push down, and it created that poor low, and you started pushing upward. So basically here, we could tell that this was a bullish setup because we were failing to find value below that initial range. Okay, so the market tested the initial range low multiple times, but it was not able to get below that initial range. So once we saw that start to play out, we would want to lean bullish for the rest of that day. Another thing we could see here, going back to the poor high and poor low that we talked about earlier, because we had a poor low form here, and you can see that price started to pop up, but it did not come back down and repair that poor low, that is another bullish sign, because if this market was bearish, it would come down and repair that poor low. Because you consolidated and actually found some value above that poor low without coming back down to repair it, then you are actually leaning bullish, okay? Because it's a failure to repair that level, all right? Okay, going back to the initial balance, the next trade setup would be the initial balance extension, okay? How you find these initial balance extension levels is you take the lowest point of the initial balance, the highest point of the initial balance, and you see how wide that is point-wise, okay? So in this case, we have 41.23 down to 40.80. So it's about 40 points wide. So for the extension, we want to take a 100% extension of that initial balance. So we would take a 40-point extension to the downside, putting us around 40.40, and then a 40-point extension to the upside, putting us around 41.65. And that would be our overall target if the day started to trend very heavily in one direction. Okay, how do you determine if it's going to hit those extension targets? Now, typically, if you see a very strong single print start to break the high or the low of the initial balance, where we start to see one session just very quickly breaking out to the upside or breaking out to the downside, if that session closes strong and it doesn't retrace very far back to the initial balance, then you are typically going to hit that initial balance extension. Okay, let me say that one more time just to make it a little clean here. So if you start to single print away from the initial balance high or through the initial balance low and you do not retrace, then you want to look for the extension targets. Okay, so in this case, we tried to break away from that high, but it couldn't get that momentum and it started to pull back and kind of consolidate and find value back inside that initial balance. So it failed to kind of create that trend day. Okay. Okay, for the next trade setup, we're going to talk about splitting the profile in one time framing trades. So if you guys are using Trade-Evade, you can click on the market profile and you can click this split profile. If you are using a broker that does not have a split profile function, all you have to do is use a standard 30-minute chart. And if it has a option for high-low candles that don't show the wicks, it just shows one whole candle. It doesn't care where the bodies are. It just shows you the highest point, the lowest point, and it shows you one whole candle. Use that setting, okay? So if you put it on a 30-minute and you just look at the candles, you can split that just as you would a market profile chart, okay? But if you use Trade-Evade, it's simple as just clicking it and click split profile, okay? So on Trade-Evade here, we can see that we split this profile and we're splitting this by sessions. So each session is a 30-minute session. So the A candle is 30 minutes and then so on and so forth. B is 30 minutes, C is 30 minutes, all the way up into the close, all right? Why do we want to split this? We want to split this because we can see how the candles are reacting to each other. Are we breaking out in one direction very heavily? Are we constantly sweeping the highs and lows? Are we double topping? Are we double bottoming? That sort of thing. So in this case here, if we were looking at the A and B session, we can see that the B session started to break out higher and we pushed up and closed towards the top of that candle. But in the C session, we actually put in a poor high. So you can see on the B to C session, we created a poor high, pulled back, and then consolidated, just as we talked about earlier when we were talking about the trade setup for the poor high. This actually gave you a perfect trade setup. And let me show you how you would have traded this. So if we screenshot this here, I can show you that just like we were talking about earlier, this put in the poor high. So when the poor high has been established, you want to see it pull away from the poor high, and then you want to see a little bit of a consolidation. You want to see a little bit of value. Okay, so we start to build up that value, then we go to repair that poor high. So you get that bullish setup. The trade was complete once the poor high was repaired. Now, like I said earlier, if you wanted to be a little greedy and you wanted to leave some contracts and hold on to that trade even after the poor high was repaired, you can do that. But just understand that very often, this could just be a poor high repair and then you could start to sweep and pull back into that value. Okay, so watch out for the sweep. As long as it's not sweeping, then you are safe. If you guys don't know what I mean by sweeping, it's basically if we have a level and we start to break through it, but then we quickly reclaim that level. Okay, so you gotta watch out for those sweeps. That is very common in the poor high and poor low repair trade. All right. But okay, going back to the split here, we didn't see that poor high until we split this profile. So let's unsplit the profile. And we can't really tell. I mean, you can if you're really good at reading market profile, but normally if you have it unsplit like this, we're just looking at the entire structure of the profile. We're not looking at the individual sessions. So yes, if you have a really good eye, you could have seen that poor high there, but look at how easy it is to see that when you just split it up, and you can perfectly see the poor high right there. Okay, so that's one benefit of splitting the profile. You don't have to leave the profile split the entire time. You can just split it, take a look at what's going on, and then put it back to normal, but it will benefit you in that regard. Okay, so a couple more setups here for the split. We have what's known as one time framing. It's a very fancy term for basically trending in one direction. And this was a perfect example of what one time framing looks like. So a one time frame, and let me screenshot this again to make it easier. What one time framing is when we have a candle. So let's say we have a candle like this, and then we have the next candle, and it pushes up and it breaks the high of the previous candle without testing the low. This is one time framing bullishly. If we break the high of the candle without testing the low of the candle, we are one time framing bullishly. Now, if we have the same setup, but we're breaking the low of the candle without testing the high of the candle, we are one time framing bearishly. Okay, it's an indicator of how strong your trend is. If this is happening back to back on continuous sessions, so if this happens for like say 5 sessions in a row, that just means that your day is extremely bullish and you really do not want to be trading in the opposing direction. You do not want to be taking shorts on a day like that. Just like we saw on this day here, if you were trying to short basically any of these candles, you would have gotten beat by that overall trend. Okay? So if we see here, we can see that, let's see, we started with the I session. So the I session broke the H session high, and then we had, we did not test the H session low. So we had a one time framing move to the upside. And then with the J session, we broke the I session high, did not test the low. Also one time framing. Same with the K session, same with the L session, but then it failed on the M session here. So you almost had a one time framing move on that M session, but you actually came back down and you tested that low. So yes, for that initial push, it was a one time framing move up, but it failed once it started to sweep. Remember we talked about that sweep? So you swept the high, you were one time framing up, but then you started to fail and you pulled back down and you went back to the low. So that was a sign of weakness, which we're going to come back to this setup towards the end of the video. We're going to talk about the closing fade setup. But for now, let's stick to this. But that would have been a weakening one time framing move. Okay, so that basically just tells you the bullish trend is weakening and you're starting to lose strength and kind of top out. All right. The next thing you can do with a split profile is you can do what's called halfback trades. So a halfback trade is a fancy term for a pullback trade that is pulling back into the 50% of the previous session. Okay, so let's screenshot this one more time. And I'll show you here. So looking at the A session here, this little purple line right here, that is the 50% mark of that candle. It is the halfback of the A session. So if the B session would have pulled back and retested the middle of that candle, then we could have taken a trade with a stop loss below the low, targeting the high. It's a perfect one-to-one trade setup every single time because you are taking a trade on the 50% of that candle. Okay, so every single time it is going to give you a 1-to-1 trade setup because you're putting your stop on one side of the candle and your target is on the other side of the candle. And you typically want to do this in the direction of the trend. So if the trend is very bullish, then you want to be taking that trade as a bullish trade. If the trend is bearish, then you want to be taking it as a bearish trade. Okay. Now, with the halfback setup, if the target was hit before the halfback was hit, that trade is invalidated. You cannot take that as a halfback trade. Now, you can take it as like a late trade, like maybe, say in this instance right here, it comes back and it retests the halfback of A, and then it actually starts to push back up. But that's a completely different trade, because what you're doing there is, yes, you are trading a support, but the target is not the same. Because in this case, if we traded this as a halfback setup, we would be entering here, stop loss here, but we don't want to target the top of the A session because this is a late halfback. We probably want to be targeting either the poor high here or just following the trend as long as we possibly can. Basically, what this trade turns into is a support trade. It's not a halfback trade. The halfback trade should be taken on the next session. So if you're using the A halfback, the trade should be taken on the B session. Okay? So let's look at some of these halfback trades that played out here. So we had the E session, put in the halfback, then it gave you the retest there, and then your target was hit. Same thing on F. You have the F halfback, you were tested there, and then you hit your target. Same thing on G. G was tested. This did not hit your target on the H session, but you could have held on to it for the I session. So there's your target was hit on the next session as well. So you can leave your trade going, even if it's not hit during that next session, as long as your stop loss is not hit. So we have our stop loss below the G low here. So even though we did not hit our target on the H session, our stop loss has not been hit. So we can go ahead and hold on for that next break, which we got on the I session. And then so on and so forth here. We can see on the J session, we have that halfback trade, which hit your target. And then on K, we actually barely missed the halfback, and then it hit the level there. But then on the L session, we had the halfback trade hit the K high. So obviously it's not going to be this clean every single day. This is just a perfect example of a beautiful bullish trend day. So if the day is extremely trendy, you don't have those kind of fake outs, you don't have those very deep pullbacks, then the halfback trade is going to be extremely successful, as it was on Friday here. But that was a perfect example. I wouldn't think that the strike rate is going to be that high every single time. Okay. All right, let's undo the split here. And let's move on to the next trade setup. The next trade setup that we have is what's known as single prints. We covered these single prints very in depth in our volume profile series. So make sure you guys go watch the volume profile series if you want to learn more about that. We're going to be talking about specifically on the market profile single prints here. So the unique thing about market profile when it comes to single prints is they're much easier to see. So if we look at a volume profile here, we can see the volume profile is side by side with the market profile here. And if I go ahead and grab a screenshot, we can see what we're talking about here. So this zone right here would be what we call a LVN zone. We wouldn't exactly call that a single print zone because they're not single prints. They're just low volume nodes, okay? But if we're looking at a market profile, those are single prints. So we have that big single print area on that K session. And basically what that's telling us is it's telling us that the K session was extremely bullish. We started breaking out to the upside, and it didn't even give the auction, or the market, I guess you would say, enough time to auction in that zone. Okay, so because we were so bullish, it just blew through those levels, didn't really have time to find value, and it started trading at a higher value. Now, you can see on the L session that we started to kind of put some value in that area there. So it broke away from that single print K session. Okay, so you started to build value. And we can see that very obviously on the volume profile here. We can see that we were building value. All right. So how do we trade these single prints? So basically, we can look at this single print area here as a price inefficiency. It didn't give the market enough time to trade efficiently in that area. So we don't realistically know if the buyers will hold up if that area is retested. So we have to see when price comes back to retest that area, are the buyers actually strong there, or were they just beating the sellers in that instance? So if we get rid of this here and we take a look at the next day, we can see what happens. The pre-market pulls back and tries to fill in that single print zone. It only fills in a couple of the single prints. It fills in about 3 to 4 of them, but it leaves these lower ones unfilled or untested. So then on the next real money session, the cash session, I guess you would say, it pulled back to retest that inefficiency zone, and the market determined, yes, there actually is a lot of value there. It is extremely bullish, and then it started to push higher. And that's when we had that very aggressive push for about, almost 100 points on that day there. So we pulled back to retest that single print zone. The market determined, yes, that is a very strong bullish level, and then we began to push away from that. So basically what you would want to do if we were trading those levels is you could draw some lines kind of where that level, the the single print zone starts and when it ends, or you could draw like a rectangle box and just take the entire zone. But just understand that when price retests that area, it should act as very strong support or resistance leaning into that overall trend. So in this case, the overall trend was bullish, so that should act as a very bullish support. If it doesn't, then you have to look for the value where that single print originated from. So in this case, the single print originated from the value around 39.80 down to 39.60. So if we don't show support on that single print zone, then the market is looking for previous value, which in that case is down here. Okay. Okay, the last few setups we want to go over here is the end of day spike and the closing fade. So this is why I like to color code my closing session. In this case, the orange session here would be the closing session. And if we go ahead and split this profile, we can kind of see what happens during that session. And there's two things that usually happen on a closing session. It's either an end of day spike or a closing fade. An end of day spike would typically be in the direction of the prevailing trend. So in this case, the prevailing trend is very bullish. So the end of day spike should have been a very bullish spike up to maybe 41.50 to 41.60. But that's not what we saw. We actually saw a closing fade. So a closing fade would be going against the prevailing trend. And what does the end of day spike and the closing fade tell us? So the end of day spike would tell us that the market does not fear holding on to their contracts or holding on to their positions going into the close of the day or maybe the close of the week if it's going into the weekend like this day was here. So if we see that closing spike going into the end of the day, that trend is typically pretty strong. They don't fear holding their positions overnight, and they're going to hold on to them until that next opening session. Now, the textbook will tell you that when you have a end of day spike, that is typically going to be a single print inefficiency, and the market is going to come back and retest that end of day spike. Now, I do agree with that to a certain extent. You will see that happen very often on the pre-market of the next day or the opening range, the initial range of the next day. But from what I've seen is if you have an end of day spike on a very bullish trend day, or you have a very bearish trend day end of day spike, and it's going in that same direction of the trend, obviously, that just tells you that that trend was extremely strong. So typically any pullback to retest that value should probably be bought or sold in accordance to that prevailing trend. So if we see an end of day spike, say for example on Friday when we had a very bullish trend, and then let's say on Monday we come back to retest that end of day spike, even though it's retesting that inefficiency, as long as it holds on to that zone and starts to push away from it to the prevailing trend, we want to hop in that pullback. That's typically seen as a pullback trade or a rebound trade. You're retesting value and pushing away from it, okay? So for a closing fade trade, it's basically telling us the opposite of what the spike is telling us. So on Friday, we had a very bullish prevailing trend, but we had a kind of a small closing fade. So it wasn't an extreme closing fade. You didn't lose very much value. You didn't even test the low of the previous session, but we did at least have a small fade. So not everybody wanted to hold their contracts into the weekend on Friday. They weren't so bullish that they didn't mind holding those contracts on the Saturday to Sunday session and then get back into the trading session on Monday. So we had a very small closing fade, most likely due to the end of the month, but that's for another video, obviously. But if you have a massive closing fade and it starts to retrace a lot of the value that you built throughout the day, then that's telling you that trend is very weak. That trend is either a fake out or that the majority of those traders that were trading that trend during the day, they do not believe in that trend enough to hold their positions through the close into the next trading session. So they are letting go of their positions, they're taking profit, and they're running away with their money. Okay. So the bigger the closing fade, the weaker the trend is on that session. All right. But that is it for the video. Hopefully you guys enjoyed this little market profile educational video. As I said, this video was not going to cover all the different day types and all the different setups with volume profile or the market profile setups that line up with market profile. This is just talking about the unique setups that can only be seen on market profile. If you guys want to learn more about the volume profile setups that line up with market profile, then go and watch my volume profile series or my order flow series. We have a playlist on YouTube called the volume profile playlist. Make sure to go check that out, and you'll learn how to trade market profile and volume profile on your day-to-day trading. If you guys enjoyed this video, make sure to hit that like button. If you guys are new to my content, make sure to subscribe. I do stream 5 days a week, Monday through Friday at 9:30 in the morning. I'll see you guys tomorrow at 9:30. Peace.